What's up, guys? Welcome to the Layman Investor YouTube channel where we talk about all things financial literacy. And today we're going to talk about some financial literacy stuff. Two very, very important concepts that I constantly get asked about. And I hope that this video illuminates and helps you understand what these concepts are. Compound interest and dollar cost averaging. What are they? Why are they important? Let's get started. Let's start with the first one, compound interest or compound growth. This is a very important concept. In fact, this concept you will find in other facets of your life. Basically, compound interest, to give you a very, very textbooky kind of definition, is your interest earning interest. What does that mean? Okay, let's break it down. Let's say you put $1,000 in an S&P index fund. S&P 500 index fund. Okay, let's say in year one, it grows by 10%. That means at the start of year two, your money has grown by 10%. So now you have $1,100 in your portfolio because you grew by 10%. So you made $100. Let's say you keep that $100 from year two to year three. Then you grow another 10% in that year. But the 10% is growth off of the $1,100 that's in the portfolio, not off of the $1,000 that you initially invested. And so on and so on and so on it goes. So every year, for the sake of simplicity, every year that you're gaining a 10% growth, you're getting a 10% growth off of a bigger and bigger and bigger and bigger nest egg. So your money is making you more money, and so your portfolio or your nest egg is going to grow at an accelerated rate. In fact, it's going to grow at an exponential rate. That's the beauty of it. What is dollar cost averaging? Dollar cost averaging is basically the idea of saying, hey, I'm going to put 10% of my income, my monthly income, into this portfolio every single month, no questions asked. It's going to be automated. Why would you do that? Well, you do that because you are a passive investor and you do not want to look at charts. You do not want to try to time the market. You don't want to be spending time in front of the computer and being like, when should I buy? Is now the time to buy? Blah, 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 blah. No, you're just going to put it on an automated schedule every single month. What ends up happening is that over the long haul, let's say 10, 20, 30, 40 years, you're going to be putting in that 10% every single month, which means on some months you're going to buy when the price is really high. On some months you're going to buy when the price is really low. But over the long haul, you're going to be paying that average price for that asset over that 10, 20, 30, 40 year period. And that way you'll buy when it goes down, when it goes up, when it goes down, when it goes up, then your nest egg will explode in growth. I think, however, both of these concepts are a lot easier to understand visually and with numbers. So why don't you follow me to my computer and I'll show you how compound interest and dollar cost averaging are two of the biggest, most important forces. That's right, forces that you must understand, especially starting out as a beginner in the game of building wealth and investing. So follow me. I'm on investor.gov, a great website, actually a government website, to calculate some compound interest. All you have to do is just go to investor.gov, go to compound interest calculator, and you'll get this little form here. Or you can even do this on Excel if you know the formula. You can just look up the formula for compound interest, super easy. But anyways, I want to show you the powers of compound interest and dollar cost averaging, and how when you combine the two together, how much more your money and wealth can explode because of the exponential growth. So let's take a look at just compound interest alone. So what we're going to do is we're going to start out with an initial investment of, let's say, $1,000, okay? We're going to do 0 monthly contributions because, again, we just want to see what compound interest alone can do for our wealth over a long period of time. So let's do like 40 years length of time, estimated interest rate or growth rate. Let's do an average of 10%, okay? I know you're not always going to get 10%. I know what the trolls are going to say. Just for the sake of easy math and easy numbers, okay? So now let's compound annually, right? And then calculate. There you go. So in 40 years, just from compounding growth alone, you would have $45,000. In 40 years, compounded at 10% annually for 40 years, $1,000. Awesome. So now let's see what would happen is if I made the same initial investment, but then let's say I added in $100 a month and this compounded annually. Wow, that's more than 10 times the amount. Okay, so when you combine compound interest and dollar cost averaging, you can see how much more wealth you can build in your nest egg. Now, let's just assume this is like you're investing in an S&P 500 index fund or index fund ETF, or maybe this is your portfolio of index funds, right? And if you want a tutorial on all that, just check out last week's video on how to choose an index fund and what index funds are. But you can see how just building your wealth slowly and letting time do its thing and compound interest do its thing over the 40-year period, your $1,000 and then monthly contributions of $100 turns into like more than $500,000. Now, let's just say, you know what? I'm making more income. Let's start putting in $200. So it doubles, right? So now it becomes a game of how much more money can you put in a month? Let's say it's $1,000 a month for 40 years. $5 million. Let's say you can put in $2,000. Let's say you can put in $3,000. Whatever. It's just going to triple now. Right? So that's 15 million. This is how you build wealth. This is why it's so important, especially starting out, for you to understand the powers of compound interest and dollar cost averaging. And which is why when you start making more money, it's important for you to then deposit or invest more money into your investments and not just spend it blindly on luxury goods or other stuff that will not grow your money to this crazy sum. Also, 40 years, right? 40 years means you started early. Maybe you started in your 20s. Maybe you started in your 30s. The earlier you start, the better. That's why it's all about investing early and often and making sure you understand these concepts of dollar cost averaging and compound interest. So as you can see, compound interest and dollar cost averaging are huge forces to be reckoned with, to understand when you're a beginner investor. And you can see how timing the market just isn't worth it. Just spend more time in the market. Once you've picked your index funds or long-term assets, whatever you want them to be, if it's crypto, if it's stock, if it's a combination, whatever it is, and you want to spend and you want to hold them for the long haul, just dollar cost average and then allow compound interest to do its thing, and then you'll have huge wealth 10, 20 years from now. Or even sooner, because then it becomes a game of how much more money can I make and then how much more can I dollar cost average. So you can see the more you dollar cost average, like per month, you accelerate the growth of your nest egg. You accelerate your pace to getting to that number for you to then be able to retire. This is the game, guys. This is the game of investing. You realize I did like no math here. I did no real analysis here. This is just understanding basic fundamental principles of compound interest and dollar cost averaging, and then probably index funds or some kind of long-term investment like Amazon. I don't know. Whatever you want, that's the game. Spending time in the market and not trying to time the market. Well, there you guys have it. Another tutorial about some financial literacy concepts that are really, really important for you to understand, especially when you're first starting out. So if you like that video, comment, subscribe, share it, drop your questions in the comments. Check out the links down below for a great side hustle course, which will help you make more money so that you can have more money to dollar cost average, which we just saw how powerful it is when you can do that. So thank you, and I will see you next week.